If AI bots are starting to write code so fast they are essentially melting the servers, how exactly do you bill for that without bankrupting your clients? Welcome to Earnings Unscripted. We are breaking down Snowflake, ticker SNOW. It is February 26, 2026, and we are diving into their fresh Q4 results. Miro, you saw the print. It feels like they're leaning into a world where AI it basically automates the entire budget away if they aren't careful.
It is a wild shift, Susie. Look at the top line. They hit $1.28 billion in total revenue, which is solid, up 6% from last quarter. But the headline that is actually honestly kind of staggering is the backlog. Remaining performance obligations reached $9.77 billion. Just so we're clear, this is all just our personal opinion, not financial advice, but seeing that backlog climb of 42% year over year is some serious enterprise gravity.
$10 billion in the hopper. That is massive. But wait, Miro, if they have that much business waiting in the wings, why did the stock just pull a disappearing act? I saw it spike to 183 right after the bell, but then it just kind of gave it all back, right?
Yeah, it ended the extended session down nearly 2%. And you have to remember, the stock was already down about 30% during the quarter leading into this. The market is really skeptical of the margin story right now. They just dropped $600 million on an acquisition of a company called Observe to get into IT monitoring. It's a $50 billion market they're chasing, but it's creating an immediate headwind for their cash flow.
So they're essentially paying for growth with margins, like taking the hit today to try and win the AI war tomorrow?
Exactly. And the bulldozer analogy you hinted at, Sridhar, the CEO, actually mentioned a partner saying using their new AI coding tools was like switching from a shovel to a bulldozer. But here's the clever bit. They're actually starting to roll out user caps on their AI agents. It sounds almost counterintuitive for a consumption-based business to limit usage, right? But they're doing it so CFOs do not get total sticker shock when an autonomous agent accidentally runs 10,000 queries in its sleep.
Can I jump in? I mean, an AI bot with no credit limit sounds like a genuine nightmare if you're running a finance department.
Right. It's the bot that bankrupts the company. But the bigger narrative here might be the Sanofi story. We have a pharmaceutical giant actually ditching some traditional SaaS apps and just building their own automated workflows inside Snowflake instead. If that becomes a trend, a lot of specialized software companies are going to be looking over their shoulders. That's
a big shift if it sticks. Let's actually get into the details of that Observe deal and what it's doing to the bottom line.
It is a heavy lift, right? I mean, Brian Robbins, the CFO, was pretty transparent about it on the call. That $600 million acquisition for Observe, it is a straight 150 basis point hit to their free cash flow margin for the full year. They are essentially adding 178 new people to the payroll basically overnight. I mean, it is a pretty bold move when you are already facing questions about GAAP profitability.
150 basis points, so roughly 1.5%. That does not sound like a huge deal on paper, but when their guided operating margin for next quarter is only 9%, that's a fairly significant bite out of the pie, right? Like, it really highlights how much they are willing to spend to catch up in the observability space.
Exactly. And the rationale there is actually pretty fascinating. They're not just buying a tool, they're trying to become the entire nervous system for enterprise data. If you have all these AI agents running around your database, you have to be able to see what they're doing in real time. Otherwise, you end up with those autonomous sticker shock bills we were talking about earlier. It's basically them saying, okay, we're not just where your data lives anymore. We're also the ones monitoring its health.
So they're the house and the security system. Got it. But wait, Miro, while they're buying new teams, they also landed a literal leviathan of a deal. That $400 million contract? I mean, can we just pause on that? How does a company even negotiate a single deal worth nearly $500 million?
It's honestly a massive shift in scale. To put it in perspective, Brian Robbins noted that they had 7 nine-figure deals this quarter. For the same period last year, they only had 2. He said, and I'm quoting him here, "We signed the largest deal in Snowflake's history. greater than $400 million in total contract value. What that tells me is that the enterprise world isn't just kind of testing the cloud or AI anymore. They're effectively betting the farm on Snowflake's architecture.
7 9-figure deals. That's okay, that's a lot of trust from the big banks and pharma companies. But sorry, can I jump in? I noticed something in the filings about their R&D expenses. There was a weird shift in how they're accounting for software development. Something about public sector deployments?
Oh, you caught that too. That's the geeky stuff I love. So, because they're starting to let the public sector take their software and run it on their own air-gapped networks, basically taking the software to go, they had to change their capitalization logic. They moved from the old ASC 350-40 internal use model to a standard market sale model. It sounds like accounting jargon, but it actually changes the timing of how they recognize R&D costs on the books. It's basically proof that Snowflake is evolving beyond just being a cloud-only service.
So they are effectively becoming a portable software company when the government needs it to be. That is a pretty big pivot from the original born in the cloud pitch. But Miro, we have to talk about the zoo in the room. The stock-based compensation, they said it dropped as a percentage of revenue, right?
It did. It went from 41% to 34%. But, I mean, let's be real here. It is still $1.6 billion a year. That is an enormous gap. It is why you see a record-breaking RPO and yet a GAAP net loss that actually widened this quarter to $309 million. You are essentially giving away a third of your revenue to keep your engineers from walking across the street to a competitor.
A third of the revenue. Geez, that makes those internal cost-crushing bots they mentioned sound almost like a necessity. I read that they are using their own AI agents to automate travel and expense reports. I mean, drinking their own champagne to save a few million while they are paying out billions in stock.
It is the tech world in a nutshell, right? But the internal adoption is actually a great proof of concept. They even have developers who programmed a bot to act like their product EVP, Christian Clearneman, just to predict how he would react to new product proposals.
It's kind of a fun way to show off the tech, but it also shows how deeply that you're trying to automate every single layer of the company.
A Christian bot. I love that. So you have a company that is clearly, they are landing massive whales. They are buying their way into the observability market, and they're essentially rebuilding their entire internal workflow around AI agents.
Right. But the legal overhang is still there. You have the credential stuffing litigation from last summer still hanging over them, and then that new AI copyright suit filed in November. It's a lot of plates to spin. Plus, they literally just walked away from their San Mateo office. They took a $108 million impairment charge just to abandon that space. It is the clearest signal yet that the old Snowflake of corporate headquarters is dead. It's all about the cloud and the bulldozers now.
Shuttles to bulldozers. I think that quote is going to haunt my dreams. Okay, so the foundation looks massive with that $10 billion backlog, but the costs of getting there are clearly putting a lot of pressure on the here and now. So where does this leave them heading into next quarter?
Well, it leaves them in this slightly awkward middle ground, right? They're guiding for Q1 product revenue between $1.26 and $1.27 billion, but that operating margin is definitely taking a hit, 9%. I mean, compared to the 12.5% they're aiming for by the end of the year, Q1 looks like the bottom of the curve while they absorb all those new salaries from the Observe deal.
Right. It is the integration squeeze. It feels like they are effectively telling investors to just close their eyes through the spring and wait for the bulldozer to really start moving Earth in the second half. But Mira, what about that massive RPO, $9.77 billion? Does that actually guarantee the growth, or is it just, a very expensive promises list?
It's a bit of both. That $400 million deal, that is a multi-year commitment, but the revenue only shows up when they actually when the customers actually use the compute. So the risk is that they've built this massive backlog of credits, but if the AI features don't drive actual usage, that mountain of RPO just sits there. Although
I have to say, Sridhar's point about the source of truth really landed for me. He said on the call, no AI model is going to help you if there are 4 sources of the truth.
That is such a call out to everyone trying to cobble together a dozen different data apps. It's a compelling pitch, but then you have these legal clouds, right? That November 2025 copyright lawsuit alleging they scraped IP to train their models. I mean, that feels like a potential wild card that wasn't exactly top of mind for people a year ago.
It is the new cost of doing business in AI. Between the copyright suits and the lingering class actions from the credential stuffing stuff, their legal department is probably the busiest part of the company. Look, my take, they're doing the right things by building a moat around the truth of a company's data, but they are paying a very, very high price in share dilution and margin pressure to keep that moat dug.
It's a high-stakes game. They are essentially betting that being the bulldozer makes them indispensable before the market gets tired of the spending. Honestly, I just want to see if that Christian bot can predict when they finally hit GAAP profitability.
I think even the bot might give you an error message on that one, Susie.
Fair point. Well, it is certainly not a quiet story. A lot of growth, a lot of spending, and a lot of bots. That seems like a good place to leave it for this one.
Done.
Tracking these cloud battles is always a ride. So if you want these earnings drops to, just land in your feed, you should follow the show, which honestly is just an experiment in using AI to find the story, like how it flagged those big office abandonment charges in the footnotes. We would love to hear your ticker requests at earningsunscripted.datamadness.ca. But for now, I am Susie, and we will see you after the next bell.
See you in the footnotes, Susie.